Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about CSW Industrials INC quarterly report. CSW Industrials Inc. offers a diverse range of industrial products through its three segments: contractor solutions, engineered building solutions, and specialized reliability solutions. The contractor solutions segment provides various HVAC-related products under multiple brands, including condensate management systems, drain management systems, electrical protection and installation, supplies maintenance chemicals, refrigerant caps, and solvents. The engineered building solutions segment offers architectural railings and metals, fire and smoke protection solutions, and pre-engineered building components. The specialized reliability solutions segment provides compounds, lubricants, and sealants for industrial maintenance and repair, as well as operation solutions and rail friction modifiers. The decline of CSW Industrials, Inc.'s CSWI stock price by over -29.76% in the past year can be attributed to several key factors. The most significant event was a $313.5 million stock sale on September 5, 2024, which led to an immediate 10% drop in shares. This sale involved the issuance of 1.1 million common stocks at $285 each, with net proceeds allocated for debt repayment and potential future acquisitions. Beyond this specific event, broader market trends such as a prolonged pullback and fading momentum have also contributed to CSWI's stock price decline. Additionally, shifting investor sentiment and concerns over the company's valuation have further impacted its performance. The stock hit new 52-week lows in October 2025, underscoring the ongoing downturn. The primary drivers of revenue growth and decline can be summarized as follows. Revenue growth drivers: innovation and proven technologies have driven organic growth, while strategic acquisitions have expanded the company's portfolio. Favorable ocean freight costs and pricing actions have also contributed to revenue growth. Key acquisitions include Aspen Manufacturing, $84.5 million, PSB Products, $26.2 million, and PF Waterworks, $105.6 million. Increased revenue from these acquisitions has also been a significant driver of growth. Revenue decline drivers: tariffs and trade policies have had a negative impact on revenue, while market softness has led to a decline in unit volumes. Net income increased by 12.1% in the 3 months ended September 30, 2025, and by 8.6% in the 6 months ended September 30, 2025. However, profit margins declined during this period. The gross profit margin decreased to 43.1% from 45.6%, while the operating profit margin dropped to 20.2% from 22.6%. The reasons for these changes are multifaceted. An increase in amortization of acquisition-related intangible assets and inventory step-up contributed to the decline in profit margins. Additionally, the inclusion of recent acquisitions had a negative impact on margins. However, some offsetting factors included pricing actions and lower ocean freight costs. Overall, while net income increased, the decrease in profit margins suggests that the company's financial performance is not as strong as it appears at first glance. The company's financial performance indicates a strong ability to generate cash from its core operations. With an operating cash flow of $122,467 in 2025, it is clear that the business is producing sufficient funds to cover its expenses and invest in growth initiatives. This positive trend suggests a stable and profitable operation, positioning the company for long-term success. The company's debt level and interest expenses have undergone some changes, but the extent to which they are significant is unclear. Long-term debt has increased from $0 to $60 million since March 31, 2025, with a further increase of $650 million due to new loans and borrowings. However, this growth may be offset by a decrease in interest expenses for the 6 months ended September 30, 2025, which decreased by $1.5 million from 2024. The impact of interest rate changes on variable rate indebtedness is also noted, but its overall effect on debt level and interest expenses remains ambiguous. The company's financial performance varied across different segments and regions. Notably, the Contractor Solutions segment saw significant growth, with revenue increasing by 31.2% and operating income rising by 15.4%. In terms of geography, Australia, Canada, and the UK demonstrated strong performance, with each region having established distribution operations. In contrast, Vietnam was a segment that underperformed, although specific details were not provided. The concentration of manufacturing operations in this region may indicate a significant presence, but its overall performance remains unclear. Management's outlook and strategy. The company is focused on niche, value-added products in its end markets, relying on a combination of organic growth and strategic acquisitions to expand its portfolio. With a strong emphasis on high-risk, adjusted return opportunities, the company prioritizes investments that generate significant returns while minimizing risk. By 2026, management expects a robust balance sheet, enabling continued investment in organic growth, strategic acquisitions, and returning cash to shareholders through share repurchases and dividends. Acquisitions and divestitures overview. The company's financial summary reveals a limited number of acquisitions and no divestitures. Notable acquisitions include Aspen Manufacturing, which was completed on May 1, 2025. However, the majority of the pages do not mention specific acquisitions or divestitures. The only hint at potential future growth is mentioned in page 11, where it states inorganic growth through acquisitions. The company has demonstrated a commitment to returning value to its shareholders through both dividend payments and share buybacks. In the 6 months ended September 30, 2025, the company paid out $9.1 million in dividends and spent $41.3 million on share buybacks, repurchasing 161,361 shares. This indicates that the company is actively managing its capital structure to reward shareholders while also maintaining flexibility for future growth initiatives. Concerns about inventory buildup and supply chain disruption are evident in the financial summary. The company's provision for inventory reserves has decreased significantly from $840 to $218, indicating a potential issue with managing excess stock. Additionally, there is a notable increase in raw materials and supplies, as well as finished goods inventory, which could lead to inventory buildup. Furthermore, supply chain disruptions are also a concern due to tariffs imposed on Vietnam, China, and other countries, affecting the company's manufacturing presence and use of third-party manufacturing. This disruption could impact the company's ability to produce and deliver products efficiently. That concludes the financial summary for CSW Industrials INC. Feel free to comment below, and I will be happy to answer them when possible.